from our beginning in 1989 to our current standing as a leading distribution partner of ICT products in India. Our unwavering commitment to empowering business through technology has been the bedrock of our success. And this milestone reaffirms our dedication to maintaining excellence in everything we do. The past year has highlighted our resilience and adaptability. Despite a challenging global economic environment, we have reinforced our position as a leader in the ICT hardware sector. India's economic growth, supported by infrastructure capacity build-up and rapid digitization, has opened significant opportunities for us. We have navigated these opportunities and agilities and innovations. Our strategy's focus has been on addressing supply chain disruption, managing inflationary pressure, and coping with rising distribution costs. We have implemented robust measures to mitigate these risks. We have optimized our supply chain management, enhanced inventory management, and leveraged technology and ensured timely deliveries and exceptional customer service. I am proud to report that we have successfully maintained a strong market position, which reflects the hard work and dedication of our team. Our adherence to the highest standard of corporate governance continues to be a cornerstone of our organization. Under the guidance of the Board of Directors, our internal governance framework ensures effective oversight and strategic direction. Our various committees, including those focused on risk management, ESG, CSR, internal audit, and financial management, play a vital role in maintaining transparency, accountability, and ethical conduct across all our operations. Our commitment to sustainability and corporate responsibility is unwavering. We integrate eco-friendly practices into our product designs and operational policies, aligning our business objectives with environmental stewardship and societal well-being. Our e-waste awareness and collection drives, along with other environmental initiatives, underscore our dedication to minimizing our ecological footprint and positively impacting the communities we serve. Our talented workforce is the driving force behind our success. We prioritize investment in talent development and foster a culture of innovation, diversity, and inclusion. By providing growth opportunities and nurturing our employees, we always ensure that we have a motivational and high-performing team that propels our organizational excellence and innovation. Honoring our commitment to ethical business practices, financial discipline, and investment in both human capital and technology has empowered us to scale efficiently and effectively. Looking ahead, our vision is clear: to continue delivering sustainable value, driving growth, and maintaining our leadership position in the IT hardware industry. The outlook for the ICT hardware distribution industry remains promising. With increasing investment in digital infrastructure, artificial intelligence-enabled data centers, 5G, and cloud computing, we are well positioned to capitalize on these opportunities. Our focus will remain on expanding our footprint in untapped market, diversifying our product offerings, and fostering innovation to stay ahead of the competition. As one of the largest ICT distributors in the country, we are delighted to contribute majorly to vast employment generation in the industry through our 51 branches and 63 warehouses encompassing 705 towns and cities as on March 31, 2024. Market capitalization of the company grew by over 30% in last 7 months, and your company find place in list of top 1,000 companies by market cap. During the year, we also added 143 employees net employment, generating full-time employment with a total tally of 1,326 headcounts. Our various CSR initiatives include service to the underprivileged section of the society in the field of medical relief, basic education, adult literacy, and model villages. On behalf of the Board of Directors and the entire team at Rashi Peripherals Limited, I want to express our sincere gratitude to our shareholders, customers, global technology partners, bankers, and employees. Your unwavering
with optimism and determination. The FY 2023-24 has been one of both challenges and opportunities. We have emerged stronger, more resilient, and more focused than ever before. Our achievements are a testament to the dedication and hard work of our entire team, the strategic visions of our leadership, and the trust and support of you, our shareholders. The major milestone during the year was our successful listing on the browsers in February 2024. On the opportunities front, we expanded our portfolio by forging strategic alliances with several prominent ITC brands, as well as establishing our presence in untapped markets. These two factors have helped us maintain our market share and the growth momentum. Despite the challenges posed by global economic conditions, we have delivered strong results. For FY24, our revenue stood at 1,10,947 million rupees, up by 17.35%. EBITDA grew by 14.8% to 3,073 million rupees. And net profit rose by 16.6% to 1,439 million rupees. Profitability remains strong, which is a clear indication of our commitment to operational excellence. We have also maintained a healthy balance sheet, which provides us with the flexibility to invest in future growth opportunities. The equity rising that we did in FY24 helped us to reduce our debt significantly, bringing our debt-equity ratio down to 0.44 from 1.53 last year. In FY25, we are committed to enhancing our value offering. In view of such opportunity, we opened an embedded application lab in Bengaluru and created a dedicated vertical for our visual display category. Our continued investment on digital platforms will drive operational efficiency and enable data-driven decision-making through real-time analytics. Furthermore, we will implement targeted marketing strategies tailored to distinct product subsegments and customer profiles, ensuring a more personalized and effective approach. To conclude, I want to express gratitude to our employees, whose dedication and hard work are the foundation for our success. I also want to thank our shareholders
as I share with you the financial details of FY24. You all would have gone through the annual report and financial statements contained therein. I would like to touch upon few data points that would be relevant for today's discussion. Last year, we touched 1,10,947 million revenue, recording a robust 23.3% of compounded annual growth rate CAGR for last 3 years. For the financial year, EBITDA was at rupees 3,177 million and net profit of 1,439 million. Return on equity for the year was 12.8%, while the return on capital employed was at 13.4%. We received CRISIL A+ positive and CRISIL A1 ratings for our long-term and short-term bank facilities worth rupees 17,000 million from CRISIL ratings, which reflects our strong and healthy financials. These ratings were reaffirmed by the rating agency in the first quarter of FY25 as well. I am pleased to report that with the dynamic and despite the dynamic and often challenging business environment, we have maintained a solid financial position this year also. Our focus on strategic cost management, optimizing operational efficiencies, and diversifying revenue streams has strengthened our balance sheet. Investments in new technology distribution channels and partnership has begun to yield positive results, contributing to sustained profitability. As we look ahead, we remain committed to delivering value to our shareholders, enhancing our competitive edge, and driving long-term growth while maintaining financial prudence. We also thank you for your continued support and trust in our company. We will now open the forum for Q&A. We have received speaker requests from the shareholders, and I'll be inviting them, requesting Mr. Kapil Pansari, our MD, to answer those, and finance, I'll be happy to answer those questions in the best possible manner and in the given time constraint. Any specific data requirements and all, we can connect offline also for detailing if you have any further questions. Now coming to first question, starting from Mr. Vinod Agarwal's question, where he has mentioned about low margins and small debt on the company's balance sheet. So I would like to mention that the margins so delivered are consistently in the range of what has been delivered this year. And as you all know that we are 35 years young company, and we have been delivering consistently the range of profits and margins which are applicable to this industry. Definitely with the size being increasing, the economies of volume will chip in and all, but again, these are finally, the industry is very matured and the margin range is defined, which is reflecting in the results. On high dividend policy, I would like to mention that, and you will appreciate that we have done this public issue on 14th of February, which is fag end of the last financial year. So this dividend of 20% was a token of appreciation and thanksgiving to the shareholders who have posed trust and support in us. And definitely as we go along, move along, and the, as you mentioned that the money has been used for working capital and the business needs, definitely the earnings will be shared along with the shareholders in a most optimum proportion as per policies of our dividend decided from time to time. On awards and growth factors, I would like to request Kapil Pansari to answer the question.
Yeah. So some of the awards last year, of course, we won from Accolades, from NVIDIA, from LG, from Lenovo, ISG division, which is their server and data center division, as one of the most promising and growth best distributor award in last year. When it comes to the growth of the company, there are very few and strategic initiatives and plan that we have. Is that to maintain a consistent growth for the company at about 20% CAGR that we have delivered over the past 3 years. The endeavor is to maintain similar growth. Make IT products available with deeper penetration in the country and available to the masses of our public at large. Our focus on local OEM, which are Make in India manufacturing initiative, will drive certain demand and will help us cater to that growth of the company. We've already mentioned about setting up an embedded lab. It is a small, it is an initiative as very recent, but the market size and opportunity is almost $2 billion. The India market is $2 billion, followed by visual category. These are the future growths of the organization that will strive to maintain a 20% CAGR. I'd like to continue with Himanshu to take up the next question.
Yeah, so on the next question by Ms. Lekha Shah, was asked for number of women employees. I am pleased to inform that 19% of our employees are women employees, numbering to 172. Along with this number of employees, one of our esteemed speaker has also asked for pre-IPO and post-IPO employee numbers. I would like to share that along with this question. We had 1294 employees prior to the listing, and post-listing as on date, we are having a number of 1326. I hope this answers your question. Any other details you would like to take offline? Now, next speaker again has asked for dividend policy. As I've already answered this question in my previous answers, so I hope that will be noted by the esteemed speaker. Next question on capex plan. I would like to mention that capex is something which is very insignificant in our scheme of business and our nature of business. Our fixed assets to turnover ratio, if you see, it is more than 200 times, which itself gives the significance. So, we have around 525 million of capital assets on our books against a turnover of 11,000 crores on a consolidated basis. So I would like to submit that it's more of working capital business, which has got a very minimum role of capex, although we incur capex in the form of technology, computers and all, which are very nominal and insignificant in nature. So expected revenue from capex doesn't make sense, but working capital definitely we make sure that we strive to get 6 to 7 tons of working capital, which gives fair idea of what the operational efficiencies could reach to. On the certification audit, we have noted your point and we will get back to you separately. We have got the questions regarding the interest in visiting the factory. Please note that we are a distribution company. We don't have factories. We have branches and warehouses. Our mother warehouse is based out of Mumbai, and we have 51 branches and 63 warehouses. On arranging the visit and all, definitely the interested members can contact us separately, and we'll be happy to, schedule the visit for the warehouses, which makes relevance for our business. Secondly, on a suggestion of creating shareholders' expenses separate fund and memento and competition in the meeting, we have noted all the valued suggestions, and we will definitely see how those can best be incorporated in our future meetings. And again, revenue, profit increase and profitability increase possibility. I would like to request Mr. Kapil Bansal to give the growth outlook.
Yeah, the growth outlook for FY25. Though we've in the first quarter, you have seen the results that we've posted. The second quarter also looks strong. Overall, for this year, we can say that the growth in the top line and bottom line will get maintained and do not see any challenge from the profiling perspective. I would like to give Himanshu to state about our EBITDA margins, the question that was posed.
So, while margins, EBITDA margins, the question was posed in absolute terms, it has gone down. So, for the given comparison periods, I would like to state that, the EBITDA margins, we normally see that to range between 2.5 to 2.75%. And it percolates down from GP level, which is a factor of various, which is dependent on various factors like sales mix and the kind of demand scenario in the market, supply situation, stocking and all those stuff. So with that, it is linked. So EBITDA, as we have delivered in the standard range only, absolute number here or there, little bit, really is a function of GP getting deviated in the standard given range only. And as I said, the industry is matured, so there's unlikely, very unlikely. It is very unlikely that the margin will, increase substantially or decrease substantially. So the standard deviation range is very well finely defined, and so are the risks associated with the margin profile. On e-commerce, I would request Mr. Kapil Bansari to.
Yeah. So Rashi Peripherals has 3 GTM strategies to garner revenues and growth. Our esteemed speaker obviously mentioned about the 3 GTM, which is the general trade, modern trade, and e-commerce. To give you a perspective, that Rashi Peripherals is a B2B company and therefore does not sell directly online as a listed. We sell to e-commerce and players who are listed on online platforms, and they in turn sell to our end customers in the market. While the handset in the mobile phone distribution, there are direct relationships that works in the e-commerce space. However, in the IT segment, usually, in fact, there are hardly any direct relationships or engagement with the e-commerce, primarily because of the large number of SKU and the complexity of demand and supply does not allow direct relationships between brand and the e-commerce players. Rashi Peripherals business, currently we do not have any mobile phone handsets in our portfolio. Our competition or the suggested question said that there is some revenue or large portion of revenue from mobile phone handset. However, Rashi is focused currently entirely on the IT electronics as of now. The next question was regarding exclusivity. About 15 to 20% of our revenues are exclusive. Balance revenue, we have other existing distribution players participating in the ecosystem. Currently, this industry is matured and well-defined distribution structure. Therefore, there are not too many changes in distribution that affects our distribution profile that will impact our revenues. The 15 to 20% of the businesses that are exclusive are small in revenue to have multi-distribution scenarios to gain focus and attention on those businesses. I'd like to hand over to Himanshu to explain about our working capital questions posed.
Yeah. So our working capital of around 55 days, which has been compared with Redington, I would like to mention that it's not an apple-to-apple comparison because of the product mix and sales category mix we operate in. So as far as our working capital cycle is concerned, we tend to balance between debtors and credits. So investment goes into the stock only. As we have mentioned, we have largest infrastructure of distribution network. Our working capital, current working capital level of 55 days is we see a scope of around 5 to 10% improvement, which we strive for always. And as our capability has increased with this IPO and equity base has increased, we very cautiously deploy the capital into the stock because that is the only investment we have into the business. The net debt which has been asked for today is in the range of 600 plus crores, and for exact numbers we can connect offline. Secondly, the IPO money getting invested into the working capital and still the interest cost, which is 100 crores. I would like to mention that the IPO money was raised in the month of mid of February and was put to use by first week of March. So practically the interest cost which is reflecting is the cost of working capital, which increased working capital, which we have in the form of debt, which we have utilized throughout the year. And definitely the benefit of the money raised, the interest benefit of the money raised will be reflected in current year because last year it has only seen 1 month of utilization. Going forward, the working capital, as I mentioned, we strive to improve it by 5 to 10% from the current level. And as far as the question of making the company debt-free, please note that the debt is taken only for the working capital requirements of the company, nothing else. And if the growth, the kind of business and the kind of margin profile this business has, if the growth goes beyond a particular point, yes, that needs to be taken. Otherwise, on optimized growth of 20%, I would say 2 to 3 years, the company can be at our kind of financials can be made debt free. Is a general outlook. A question on who owns the minority shareholding in our subsidiaries. I would like to mention that in our Singapore subsidiary, which is PTE, the existing promoters of Rashi Peripherals only own the balance 24.27% in the PT subsidiary. And as far as JetNet is concerned, we own 51%. And the founder promoter of the subsidiary, Mr. Munesh Jadon, and through his family family and friends owns 49% of the share. Coming back to next question of DAS, I would like Mr. Kapil Bansari.
Yeah. DAS is a new business model that we are seeing. In the past, we have seen like software as a services business where software has become services rather than buying the entire license. You pay monthly installment. Similarly, that software translated to platform as infrastructure, then infrastructure as a services, which is on the data center side. We are looking at in the future that even devices will become as a service, where the individual or a corporate do not have to pay the entire value of the product upfront. They can pay on a monthly and an ongoing installment-based services, similar to the EMIs that the consumer takes. This is still very early stages and on the drawing board of our organization, that how do we cater to increase demand and operational capabilities to service such new business models that will come in the future. I would like to continue by saying that Rashi's business on market shares, we divide the business into two business groups. One is lifestyle and IT essentials, which is every individual product or components of PC inside the box and outside the box, like keyboard, mice, CPU, memory, hard disk, solid state drives, monitors, etc. In this category of business, Rashi Peripherals have market shares ranging from 30 to 40%. The second business, which we call as personal computing, enterprise and cloud solutions, which is fairly newer, we have an average market share between 10 to 15% only. This is where the larger revenue of the industry also lies, and therefore the growth prospects for the company. With regards to one question on the effects of budget, to give you an update that there has been no effect of budget in this FY 2024-2025. Any changes in the custom duties or import duty structures usually gets passed on to the customer both ways. Therefore, we do not have any effect on the organization. What you can expect from the company is the consistent growth, deeper penetration, and availability of IT products across India. How do we compete with RIL and Ingram Micro? We've already mentioned that this industry is currently well-defined and matured stage. The terms of trade are usually the same between all distributors, irrespective of the size. In each of the participating category of products, the revenues are comparable, the opportunities are comparable. Because Redington or Ingram that was mentioned in the call have larger base of equity and capital deployment, are into businesses where we are also not existent, for example, software, services, and in printing solutions. I would like to hand over to Himanshu to discuss about inventories and receivables.
So other questions was like 7 crores receivable write-off. I would like to say that our mention that our long-term receivables are in the range of long-term provision for doubtful debts is in the range of 0.01% to 0.02%. These are also covered with the credit insurance we normally take for our receivables. So practically the provisions are covered by insurance to the extent of 95% indemnity, which is one of the best coverage in the industry we have. Secondly, on contingent liabilities from 214 crores to 400 crores, we would like to mention here that last 35 years, we have not lost any significant tax demand from any of the authorities. However, these notices, the sudden increase in notices are due to the GST notices which have come for financial year 2017 and 18, where the timelines of assessment for the authorities were getting completed. So they have issued the notices and we will be explaining them in due course of time. We have best of consultants to advise us on these matters, and we don't see any major challenge in the notices so received. However, as a prudent accounting practice and disclosure practice, we mentioned those as contingent liabilities. On inventory obsolescence, I would also like to mention that as the prevalent industry trade practices, the obsolescence normally doesn't comes or hits the financials of the business and are more a concern for the vendors. Next question. I think we have tried to answer all your questions in the best possible manner, and any further detailing, I would like to request the shareholders. They can anytime reach out to us through our CS team, who has been proactive, and thank you for acknowledging that their promptness to respond to your queries. And we continue to live up to your expectations and serving you better. We have noted the suggestions for having more connectivity with the shareholders and all, and we will definitely this is our first